Hi, I'm Mark King, Investment Editor at Columbia Threadneedle Investments. Joining me today is Mark Burgess, Deputy Global Chief Investment Officer and Chief Investment Officer at EMEA. And we're going to discuss some of the key themes driving markets. These include the recent Turkey crisis and emerging markets, the outlook for Japan, European growth and the dollar. Mark, let's start with emerging markets. We obviously had a blowout in Turkey recently. What are your thoughts on that crisis, and has it had any effect on the broader emerging markets region?
Well, it has to some extent, and clearly the headlines were all about Trump's trade policies and the disagreements and that acting as a catalyst. But from our point of view, we think this is just a good old-fashioned emerging market crisis which generally come around when countries run deficits, borrow too much of other people's money and lose control of both the balance of payments and current account and fiscal deficits. And that's what's happened in Turkey. They've been expanding their economy, growing more quickly than was warranted, growing credit formation, and that credit formation largely taking place in US dollars, which obviously is a foreign currency to them. Markets started to get nervous about that, and when the trade policies and the tariffs were introduced, that acted as a catalyst to get investors really taking flight from Turkey for that reason. And I have to say, they exacerbated the problem by really hollowing out the authorities. So there's been a real hollowing out of the civil servants, and so the global investors' response to that was, well, you're not going to put in place the policies that are necessary to control the situation. Specifically, they have absolutely said they won't raise interest rates, which would be the typical policy response to that problem. So all of that led to Turkey selling off pretty aggressively. Now, on many levels, this is a very Turkey-specific issue, but it has led to investors to think about those countries which run external deficits and require dollar financing. And I think for the medium term, they'll probably be vulnerable because it is possible that we'll have a similar run. But as I said, this is a very Turkey-specific issue brought about by lack of independence of the authorities and the aggressive expansion of the economy financed in US dollars.
And as you say, recent dollar strength hasn't helped, of course. What is your view on the dollar from here?
Well, we think the dollar looks a bit overvalued on a number of measures, but we can understand why it has been strong. Whilst there's been a bit of risk off and a bit of flight to safety, I think the dollar's benefited from some of that. Clearly, the US economy is growing more rapidly than the other developed economies and is therefore raising interest rates more quickly than Europe and the UK and Japan specifically, and that's led to some dollar strength. And clearly the economy is growing nicely, clearly underpinned by the tax reforms that we saw earlier this year. But to us, this feels a bit sort of foot to the floor. So clearly we're towards the end of the cycle. Unemployment's trending down towards 3.5%. It doesn't feel to us to be the right time to be adding fiscal stimulus. And quite a lot of analysis would suggest that the dollar is inversely correlated to both the current account and fiscal deficits, and we think the growth of the US economy will exacerbate both of those things. So other things being equal, we would expect the dollar to weaken from here. On some other measures, it looks to be about 10% overvalued. So as I said, other things being equal, we'd expect to see the dollar weaken, but it's very difficult to call the timing of that move.
Moving to the regions, and from an asset allocation point of view, Japan is still one of your favoured regions. How is Japan poised for this second half of the year?
Well, we think there are a lot of structural reforms going on in Japan which make the bull case quite a long-term story. Specifically, there has been a sort of widespread adoption, if you like, of kind of broader capitalism. So Japan for many, many, many years have run their companies not for the interest of shareholders but for the interest of employees. As you know, Japan's maintained full employment even though the economy stagnated for 20 odd years. But increasingly, companies appear to be focusing on improving return on capital employed, improving free cash flow, and improving returns more generally so that shareholders benefit. And this is likely, in our view, to sort of drive equity performance longer term. Now, in the short term, Japan's done well, and also, as well as seeing the dollar rally on a kind of more risk-off sentiment, we've seen yen strength as well, which obviously doesn't help Japan's very large exporting sector. So that has led to a bit of weakness in Japanese equities in the short term, but medium term we remain very, very convinced that the corporate governance reforms will drive share prices.
Okay. And have you seen anything from the US in the last few weeks that's changed your outlook for North America?
No, and we take some comfort from the reaction and performance of the bond market. So clearly growth continues to drive corporate profits, but valuations in equities are looking, sort of fuller rather than cheaper generally. But they look attractive versus bond yields. And the tightening of interest rates in the short term has led to a flattening of the yield curve. So long-term interest rates haven't gone up, and our view is that they haven't gone up because the market is confident that the short-term interest rate rises will take inflation out of the system. So that's been a positive, and that will support both bond valuations from a credit perspective, but also equity valuations as well. And that trend's continued, i.e. the yield curve has flattened even more over the last couple of weeks, and for as long as that continues, we think that kind of underpins equity markets and is good for risk assets more generally.
And moving to Europe, growth seems to have stalled in the first half of the year. Are there signs that the European growth story can continue from here?
Well, Europe is earlier on in the cycle. Unemployment in a number of countries has got a long way to fall. We think that in a way, when there's been a lot of focus on Brexit in the UK, in a way Brexit's been a unifying experience for Europe. And we think that the outlook for European growth is pretty good, actually. It's exposed to a stronger euro, and if the euro were to strengthen, wouldn't be our central case, but if the euro were to strengthen further from here, that would put a bit of a headwind in front of the large export sector in Europe. But no, we think Europe is still a good place to invest, and some of the shorter term leading indicators would suggest that growth is accelerating again.
Some of the data, especially out of Germany, has been improving.
Absolutely.
Mark, thanks very much.